The studio is Andrew Canter, the CIO of Futergrowth Asset Management. Andrew, let's explore this scenario that Europe is exporting deflation and recession.
Yeah, it's an interesting concept. In the old days, under a gold standard, if a country got into a current account or a trade imbalance, they had to have domestic deflation. Prices literally had to drop in order for the country to export more. But now in the new era, since the 1930s, 1970s, after the gold standard left, countries devalue their currency. And then what happens is the cost of their imports rise and their exports drops. So in effect, Europe had this fiscal crisis earlier this year. The euro plummeted, as we saw, dramatically against the US dollar and other currencies. So in effect, what's happened
we hit almost that 118 level on the euro dollar.
Exactly, and some people were calling it for par, including myself, by the way. So the fact is, it takes European unemployment and basically through the export mechanism moves that unemployment somewhere else. Now the remarkable thing is it's happened so quickly. It was almost immediately that the US economic data suddenly went a bit weaker, and the German economic data in particular in Europe went materially stronger, much faster than these things normally happen. I mean, it was a matter of a couple of months rather than the normal 18 to 24
But that was
lag.
a result of the weaker euro, surely.
Yes, exactly. But the remarkable thing is it happened quickly. Now, I think we must be cautious about Europe because Germany is having a party. I mean, they're all, the euro is weak, we're suffering, but they're not suffering at all. They're exporting, they're having a big employment creation party, their manufacturing production's up, the surveys are up, the IFO's stronger. But peripheral Europe still has to go through this strong fiscal contraction. There is still going to be a lot of unemployment and a lot of disinflationary forces in Europe.
Coming back to the stress tests, we saw them published on Friday, and there's much criticism that they weren't tough enough. And again, just for our viewers, 91 banks went through those stress tests, 7 failed, and 5 of those in Spanish territory.
Yeah, that is the allegation, is that the stress tests weren't stressful enough. But I think the key concern of people is that a lot of the banks' holdings on their balance sheet are sovereign debts of various European nations, and they didn't stress those values in particular. Now, there's a couple of implicit statements there. The first implicit statement is the European Central Bank or the Eurozone in general has already said they're going to bail out those nations anyway. So they could have stressed them, but it wouldn't have been the truth. The truth is those bonds will be bailed out by the central banks, probably, or that's the statement in the stress test. And second, there is access to this emergency capital pool that's been established. And most importantly, it's some numbers. The analysts can do their own work and determine themselves how stressful they need to be to determine which banks are strong and need to be recapitalized.
What are the outcomes here? Can the Eurozone, in your opinion, fall apart, or is that now off the cards?
I think it was never on the cards, in truth. There's two elements to the Eurozone falling apart. Can it literally spin across into space? It was never going to happen. My analogy is, if you think it's expensive getting married, you should try getting divorced. It just wasn't going to be.
You've obviously been through both experiences, have you?
In fact, not. I've learned from the experience of others. So that's one element. It was never going to come apart. The political and economic experiment that is Europe and the Eurozone is going to persist, is our view. But the other question was whether some of the peripheral countries could abandon the euro itself and go back to their own currency. And I don't think that was ever going to happen either. If Greece went back to the drachma, their banks had nothing but euro liabilities, and then they'd have drachma assets. It was a recipe for disaster. It wasn't going to happen either. So basically, Europe is in this sink or swim together.
Sink or swim together, but could we still see a sovereign default?
I think the word default will be interesting because it won't be used when it happens. There will be restructuring or rescheduling or something if certain countries, in particular Greece and possibly the Portugals and the Irelands, get there eventually that they can't service their debts, that they'll have to make a deal with their creditors to push out the repayment terms. And that'll be a rescheduling, won't be called a default. And it will be a non-event because the market at that point will be pricing their debt at 85 or 75 cents on the dollar or the euro, and so it will be a non-event.
Against this backdrop, let's focus now on the global bond market and the fact that developed bond yields have collapsed.
Indeed. So your U.S. Treasury, your 10-year Treasury is below 3%. The European kind of 10-year benchmark's 2.5%. I'm speaking in rough numbers. And what they're really pricing is that risk of a double-dip recession, that this exportation of deflation and recession and unemployment around the world is going to cause potentially a double dip, and the bond markets are pricing that. There's also a bit of a risk aversion trade in that. Well, we don't know where to run to, so let's buy U.S. Treasuries. Interestingly, and this is a really interesting side story, is we've seen enormous capital flows into the South African bond market this year. It's over 50 billion rand, 56, 58 billion this year alone. It's a huge amount of money, and there's this.
We also saw strong inflows into the bond market last year. from foreigners.
Yes, it keeps coming, but I think there's a structural shift where historically our bonds were used as trading instruments, buy them, sell them, buy them, sell them. That now there's a structural shift where people in the world are saying, well, where can I don't trust governments anymore. Where can I put my money where I think I'm getting better diversity and more fiscal conservatism? And where do you go? You go to a place like South Africa, where we actually have quite good fiscal regimes. Certainly our deficit to GDP and our debt to GDP is much better than the developed world. And this is not just a South Africa story, it's a general movement into local currency debt.
Credit default swaps, it appears that investors are differentiating between good and bad, and here perhaps we can use the example of South Africa and Greece when it comes to credit default swaps.
Yeah, indeed. During the Greek crisis, the price, let's not speak CDS, that's a rather confusing lexicon. It is a marginal cost of funding, where Greece at one point, their marginal cost of funding during the most recent crisis was over 800 basis points above US Treasuries, whereas the South Africa sovereign cost of funding above US Treasuries hardly moved up at all. The market, unlike the crisis of 2008, when everything got hit, the market clearly differentiated between the bad guys and the good guys. And that's a very positive story. It shows an efficient market. It shows a functioning market.
So South Africa, in your opinion, is in a better position to survive. Could you put to that statement, irrespective of what happens on the global stage?
I don't think so. I mean, basically an awful lot, and we've even seen it in the Reserve Bank statement last week that our manufacturing sector is already under strain because of European weakness, for example. So no, we aren't going to, what was the word we used to use, decoupling. We're not going to decouple from the global stage or the global environment. If there's recession in the world, we're going to export less. What we are benefiting from is the fiscal and monetary policies over the last 15 years, which have been conservative and have made this a relatively stable and relatively safe destination.
Despite being a relatively stable, safe destination, I know you've been in presentations all day, but we had our second quarter jobs numbers out today, and 61,000 jobs lost in the second quarter. We've seen the unemployment rate ticking up from that 25.2% level to 25.3%. That could be the destabilizer.
Well, it's an interesting thing. It's very hard to see what we're seeing with unit labor costs in South Africa in the first quarter rising by over 9%. And productivity shrinking, even though we've had about 1 million jobs lost in the past 18 months. It's really extraordinary, and still we're getting these high wage settlements that have the Reserve Bank so scared, despite job losses. There's some disequilibrium in the South African labor market that is allowing these inflationary forces to fester and reducing the flexibility of businesses to adapt.